Hello everyone, my name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. Well, AIF and PMS Experts India is a digital platform. So we are emerging as one of the largest platform for investing in alternate investments and portfolio management services. So we've been organizing these knowledge-based sessions for quite some time now. In fact, in the recent past, we've concluded AIF and PMS conclave, where we had more than 4,300 registrations and close to 1,800 people were live when we were organizing the sessions, and we have had an opportunity to interact with Samir over there. So once again, we are back. So we, what we do is basically we'll try and read. Firstly, we invite the industry experts. We try and read their mind, understand what's happening in markets, try to understand how do we create maximum wealth, which are the sectors which looks to be extremely good going ahead. So we're going to deep dive the entire thing with help of Samir. So first of all, let me welcome Samir. Samir, thank you so much for accepting our request and taking the time out from your busy schedule and agreed to speak to all our investors live.
Thank you, Vikas. It's a pleasure to always be here, and any chance to interact with investors is always something that we never miss an opportunity, and hence it's a pleasure to be around.
Right. So let me have the privilege of introducing Samir first, because I can see that some of the people have joined our session for the first time. Samir brings about almost 2.5 decades of track record. In fact, he's one of the old hand, I would say, in terms of equity investing. He has worked with large organizations like Sher Khan, Motilal Oswal, Enam. They are also known for their own equity expertise, in the sense that overall DNA of those organizations remain very, very strong on the equity side. And having done that, he has spent good amount of time with Adani Group. He was instrumental in terms of setting up their family offices. So he was on the other side of the table in terms of generating alpha. He's known for alpha generation. He has worked with, on the asset management side, he's worked with Invesco for quite some time, managed their strategy, which is rise and down both, apart from Caterpillar, where he's really generated significant alpha, I would say. And now he's heading equities at Aditya Birla Mutual Fund on the alternate side. What we're gonna do is, if you have any questions, please feel free to write your questions on either chat box or Q&A box, and we'll start the conversation now. So let me ask my first question, Samir. Nifty is at all-time high, Sensex is at all-time high. Everybody's saying, but I don't know, is this the right representation or it's a wrong representation? I really know. No idea. Probably you can throw more lights in detail. So my first question is, what's your outlook on the market?
Well, because I think equity is a long-term asset class. So, we've just seen in the last 3 months, everybody who was expecting a US recession by the end of March, I think we are pleasantly surprised to see the markets rally 10-12% in the last 2.5 months. And, reasons come later. So therefore, whether it be revival of FII flow, etc., etc. But I think at the end of the day, what has clearly stood out for India is that the earnings have maintained strong momentum. So, if you are seeing the March quarter numbers, people were expecting that because of the recessionary trends, etc., there will be deep cuts, people have cut back spending, etc. Unfortunately or thankfully, aisa kuch hua nahi. And, I think I'm happy to say that growth outlook, even from where we stand, looks pretty good for us, both as a country and economy, and hence the markets. So therefore, the underground, or rather the underlying optimism, is based on the fact that there is a very strong earnings revival that is clearly under play here. And maybe that's the reason why, the big trade of people betting on a China revival at the start of the calendar 23, I think people realize that perhaps, that is not going to turn out that way. And hence they immediately changed track, and we saw a lot of flows coming towards the India market post March onwards. So I think somewhere there is an underlying basis, and that is getting increasingly borne out by the fact that now our central bank has had two successive pauses, and at the same time, quite rightly so, because now inflation has hit almost. Today's the number was quite startling for most people, and that shows that somewhere uh, we are having a good starting point ahead of a monsoon, which might be a bit impacted by El Nino, but at the same time that I think the challenges that the world faces in terms of rampaging inflation and anemic growth, at least India doesn't seem to be very currently at that point at all. So maybe that's the reason why we are where we are in terms of the market. Yes, 18,700, 800, 900 is just a number, but at the end of the day, I think what people buy is from here, how does the next 2 3 years look? And on that basis, I think I'm happy to say that at least the March quarter doesn't show any signs of any imminent danger. Well, there is expected to be some sort of a slowdown, at least expected in the first half. But I think since we don't seem to be having very aggressive growth estimates on the aggregate market as of now, I think we should be okay. I don't see the earning momentum getting materially affected even as we go past June and September. Because if you see the composition of how the March has played out, I think the forecast is still strong at about 20% earnings growth. We've seen shades, pockets where you've had some upgrades. Most financials have had upgrades, autos have had upgrades, and IT, cement, industrials have been a bit soft. But that's okay because most of them, IT had a great run from 2020 to 2021, and industrials has seen order book ramp up, and now they will see execution pick up. And cement typically doesn't do anything worth mentioning, at least closer to monsoon. So I think we are fine. I think there's no cause for worry as such. And the only thing is that yes, in case the El Nino effect gets worse than what is expected, because frankly we haven't had a real case of a very deficient monsoon in the recent past. And coupled with the fact that there are 5 state elections to go, coupled with the fact that next year there's general elections, I think then it becomes a bit of a heady cocktail. But apart from that, I don't think there is anything that one needs to be concerned about overtly. Macro is looking good. Oil is behaving itself. So I think macro, at least from an India perspective, is looking great. Inflation seems to be definitely not as big a worry as it is for the most parts of the world. Our interest rate cycle, at least if there is no cut, at least there doesn't seem to be any case for an imminent hike. So I think we are fine. And in terms of where the markets are, well, yes, in 2.5 months we moved almost 12%. So maybe some sort of a normalization is fine. But otherwise, we are fairly constructive on the market because we think that there is still enough and more ideas available where you don't need to buy 50 60 multiple stocks. You should look for growth, which is not being quoted at any price. And I think we have a reasonable chance of constructing good portfolios, which should be able to deliver the returns.
Interesting. So, Samir, we saw FIIs turning back and started buying. So, what's your views on that?
Well, as I said, it was basically something that they had earlier shifted the stance to China allocation going up because maybe there was a reopening trade there, but they soon realized that that doesn't seem to have too many legs, and maybe that's the reason why they quickly reverted back to India.
But when you see, the overall emerging market allocation particularly was very less from FIA's point of view. Do you see this is likely to reverse this financial year?
Well, it has to be seen in blocks because, like for example, FIIs was selling pretty much till, starting from November 21 till as late till June 22. After that, for the entire 7, 8, 9 months, they were just selling. So, and that, mind you, to our mind, it is not because they were negative India. I think that was clearly because they thought that there is a situation of they were still able to make an exit in India from current investments and make up for the capital recall that was being happening all over the world because of the fast Fed rate cycle. So it's not that it was an India negative call. It was because here they were still being able to take some money out and service the capital recall elsewhere. So maybe that's the reason why they were still being able to sell at a profit, whereas most of the markets, perhaps the exit doors were not that available, or the prices were not good. So I think maybe that's the reason why we saw those large amount of sales. But I think FIIs, they typically, if you look at their aggregate ownership of the India market, has not changed much. I think they still own about 20-22% of the float, so which is not too bad.
But
So
when you look at the historical numbers, Samir, sorry to interrupt, number looks to be extremely high, as in from 30-31 to coming to 21-22. What's your views on that?
see, I think let us not look at it from the sense of a 30 number going to 20, because it is also a case of prevailing valuations at that time. So, obviously the money is here to make a return. So if he's getting an entry about 11-12,000 Nifty, is very different from probably putting the same amount of money at 18,000 Nifty. So, I think it has got to be a factor of that as well. And so the fact is that yes, we are trading close to probable upper ends of the most valuation bands as per historical averages. So it's not that unless and until they are other regions look very bad or we look extremely good, maybe at this market level they will not be coming in with the same gusto or same commitment as perhaps they were doing at 20% lower.
Maybe they might be chasing valuations on the other markets also. Because
well, that's what I said. They tried doing that in China around December, Jan 2023. But the economic growth story in China didn't seem to have very long legs. So therefore, the Chinese data didn't seem to evoke much confidence, and therefore that trade then again got sold back. So it's just a function of they still own far more China than what they do in India, because even at say $3.3 trillion of our market cap, I think they probably own about 22%, which is close to about $700-800 billion, which is probably a fraction of what they own in China.
Sure. So what is it that your team is doing now, Samir? Coming back to Aditya Birla, where are you focusing? Which are the top 3 sectors or 4 sectors that you are looking at which can contribute? During this financial year, they can contribute significantly.
Well, because I think we have various mandates that we run here. So, we like to populate our portfolios with, as many ideas as possible. So even though we run concentrated portfolios, but we run portfolios across various styles. So there is a large cap growth, there's a small and mid cap growth, there is a, multi cap value. So I think for us, the basic tenet that we like to look at is that we need to be able to construct portfolios where the peg is not very high, because the markets are almost at close to all-time highs. So at most portfolios are constructed with a peg of not more than 1 to 1.2, which means that if it's a 22-23% earnings growth capture, we don't like to buy portfolios which are quoting more than 25-30 times. So I think that is where we are, because we believe that that's what gives us a bit of anchoring. It gives us a certain amount of
Comfort.
stability and comfort, and more importantly, good night's sleep. So all our portfolios are typically low beta portfolios. We don't run more than 0.9, 0.95 portfolios. And at the end of the day, we try and mix and match through combinations of median market cap and weighted average market cap. So, for example, our the small and mid cap growth portfolio, which is a select sector portfolio, that at least in the last month may not have had done well, because last month it was a runaway rally where most of the down the cap curve companies have done very well. So to that extent, yes, we have lost out a bit in terms of performance, but I think on a 1 year basis we are consistent in what we are doing, because we've seen merit in running portfolios this way, because what you give up in maybe month or two gets made up in probably 15 days when the market turns. So we are not very fast about trying to be the highest return generator in the shortest period of time and across time frames. But today the valuations are quite reasonable across most sectors. There is a high element of optimism built into the stock price, and at some places execution now has to catch up. Otherwise there could be meaningful downsides as well.
Okay. And which are the 2-3 sectors you're bullish on as a house? Would you like to answer that?
See, we like, for us, industrials is a good place to be. Financial will always remain a good place to be, but we don't buy anything and everything in financials. Thankfully, there is a lot more to choose and pick from in financial nowadays. So one can buy, across the curve. You can buy PSUs, you can buy standalone health insurers, you can buy asset management companies, you can buy power utility lenders. There is a whole gamut. So we like financials, we like industrials, but industrials, of course, valuations are becoming a bit stretched. Discretionary, yes, most of the consumer facing businesses. In fact, we've just closed a fundraise for our services fund, and there we had exposure to quite a bit of these tourism, hospitality kind of themes which have done well, and we still believe that there's a fair amount of growth that can still be had from them.
Right. Are you also planning to raise some more money on the other side, maybe on the AIF PMS? So if I'm your investor, where should I give you mandate, AIF or PMS, and which one?
Well, as I said, we already just closed our fundraise for services, and now we will be actually offering the services on the PMS platform as well. So although the fund that we closed was a closed-ended Cat 3, so that is now closed for subscription last week. But on the same theme, now we have a PMS which is available for investors. And at the same time, we hope to bring another existing PMS. So we are having both situations. An existing PMS product which has a 5-year track record, which is our special opportunities fund that we are bringing on the AIF platform, and a current closed-ended Cat 3 which we closed last week, we are bringing on the PMS platform. So we are doing both.
Oh, that's wonderful. So you are, I mean, you don't have to ideate too many things. So same ideas are being replicated.
Because we believe these themes are fairly sustainable. We believe the underlying argument or investment thesis still remains valid, and that's the reason why, because I said we construct portfolios which are not very high multiple but high growth. So therefore, those ideas are still available, and we believe that yes, we can. Why should there be a disadvantage for an investor who's having a belief in the theme by virtue of a product construct? For example, if a closed-ended Cat 3 has to close at a certain date, it has to. But in case the theme somebody still believes in, so we should make the product available on the PMS platform as well. So
Yes,
we're doing it. And same thing on the special opportunities. It's a product that we've been running now for the last 5 years with a reasonably strong track record. So that if somebody wants to come in on the AIF platform, so that we are now catering to on the AIF side. So the themes, these are long tenure themes. They will remain in play, and we believe that in case there is alpha ability that somebody can participate in, then it should be available on both platforms, whether be it PMS or whether be it AIF.
Right. So before I come to the kind of process that you follow at an organization level in terms of selecting stocks, both on the AIF and PMS side, my question, and this question I keep getting from a lot of investors, assuming that you have service fund, service as a theme, and you've raised money under the AIF platform. Now, same thing you're making available on the PMS platform as well. If I'm your investor, where should I give mandate? Like which instrument should I choose, AIF or PMS? And what are the benefits and limitations of that?
Well, because I think, see, AIF is very clear. The minimum ticket size is 1 crore. You can give it either through a drawdown of 10 by 10 or minimum 30% or upfront 1 crore. So the minimum ticket size is a clear differentiator. And AIF is a unit NAV. You get an NAV whereas PMS, it is direct in your individual investor name. So there is a pool concept there's a taxation also is different. The AIF withholds a tax and deducts the taxation component while redemption, whereas in PMS, the tax is borne by the investor because it is not a direct name. So those are the only differentials. But for us, it is
No, sorry to interrupt. From a fund manager point of view, because for you it doesn't make much difference which platform. For you, ultimately, you need to deliver returns in the hand of the investors. So, what difference for you and your team? What kind of difference you see, or is there a chances because somebody is giving a mandate of 1 crore, will have an additional, say 2-3% additional alpha over PMS guide, or it is a wrong myth?
I think it, there is no differential from a fund management perspective on whether the product is a PMS or an AIF. Because as far as we are concerned, we buy the underlying stock for the earning potential that we believe it has and at the multiple at which it is available. Now, the only difference is that in an AIF, if it is a closed AIF, there is a more runway for the stock to be able to deliver that return. I mean, if it might be a 3-year lock-in, it might be a 5-year lock-in, whereas in a PMS, it's an open structure. So I think there, if one doesn't believe in the theme or one has a liquidity need or whatever, one can redeem. Whereas in AIF, exits are not that easy. But from a fund management perspective, as far as I'm concerned, in the PMS also I manage it as per model portfolio, and so I do in terms of AIF as well.
So in terms of flexibility which is given to you on the AIF side, that you can also invest in some unlisted space. So as a fund manager, do you think about exploring this also as an option for your AIF Cat 3?
Well, to be honest, in Cat 3, I don't think we've completely exhausted all the available opportunities in the listed public markets. So, even though, yes, it is an enabling flexibility given because of the structure and the platform, we are quite content by, looking at only on the listed space.
Okay.
Because we believe there itself, there is enough and more to be able to construct a reasonable 30-35 stock portfolio, which is well balanced. And why should I unnecessarily take on the illiquidity risk?
Right. So I think keeping that aside, I think if you look at in terms of flexibility, both AIF and PMS are similar. In fact, in AIF, rather, it is restricted that you can't have more than 10% in particular stock. But in case of PMS, you can have as much as 15%, 16% if you're bullish on a particular company. Number one. Number two, on the long side, what you rightly said, if you are a long-term investor looking at giving mandate to Aditya Birla and Samir for over 10 years, I think clearly it's a PMS, open-ended, open architecture. Same thing is, same portfolio is. So do you see some changes in the portfolio also, Samir? That's another question between AI.
Well, I think if, for example, as I said, I manage it as per a model portfolio. So if today I'm holding a particular stock, it's say a 3-4% weight, if I have held it at my first investor, and today also if I'm continuing with it, there should be no reason why if somebody comes in with subscription money today, I should not be, why should I be shying away from buying it at the same weight?
Okay, so you're saying that essentially, I mean, it's more of a call of the fund management team to decide what percentage you would like to have, and the weightages are defined in the same fashion on both, no matter which platform the investors have.
Because see,
Board.
the weight, or should I say, the weightage of a particular stock in a portfolio is a measure of our confidence on what it can do. Obviously, there is some amount of match weights with respect to the benchmark, because you don't want to be completely away from the benchmark also. Because when we run concentrated portfolios, there is also an added risk that our benchmark has probably 10 times more the number of stocks as we buy. For example, we might have a BSE 500 or NSE 500, whereas we don't buy more than 30-35 names. So how will I be able to beat the benchmark of having 500 names by owning only 30-35 stocks? So I need to be able to allocate weights more to where my conviction is, where I can see that this will more than make up for all the others that I don't own. So the weight sizing is actually done with respect to the measure of conviction. So, and plus there is also a way as to how do we do it. So there's no point of buying of any stock at say a 6% or 7% weightage in the portfolio day one, because that means that in case for some reason that stock goes for a protracted underperformance or a consolidation mode, it will unnecessarily cause or drag the performing portfolio because of its disproportionate weight.
Yeah, sure.
So I think the weight sizing is the best way, at least to our mind. The way we work is that if we like it, we first initiate at minimum 2.5%. If we like it more, we start understanding after every quarterly results, conviction builds. We probably bump it up after you don't buy anything active beyond 3.5, 4. Then the stock has to perform and take its way up.
Right. So, Samir, talk to us about your philosophy also. Do you have any kind of defined investment philosophy, or you look at that, it depends on the fund manager and the team, because ultimately they are managing the funds, number one. And number two, also, if you can talk to us about your PMSs, which are like open-ended offerings. If any of our investors who have joined maybe wish to onboard.
Okay. So in terms of what we run is, I'll just share something which is our philosophy. Can I share the screen?
Yeah, sure. I'll have to make you post. Yeah.
Okay. So if you see, now this is what our philosophy is. Now this is how we manage money. This is what we aim to do. Now, if you look at, we are very focused on very simple things, as if, and we state that upfront. For example, if you look at, we have said that we are trying to capitalize and identify the inefficiencies in the marketplace. So, this is when we stated there's a reason why we kept that as a philosophy. So we aim to identify and capitalize upon the prevailing market efficiencies in a simple, timely, and efficient manner. Simple, which means I can explain that to you. Timely means it has to have some finite actionability, because otherwise prices move. And efficient means I will not be able to capture everything, but I should be able to capture quite a bit of it. And how we do that is we focus on businesses. So if a business where a promoter has constructed a business to be able to deliver and grow earnings faster than nominal GDP, which means the cost structure has been so built, the capital structure of the business has been so created that if I can grow earnings faster than nominal GDP, I should be able to generate economic value year on year. Which means if that happens, I should be able to get a reasonable multiple also for it. And so we focus not on stock prices, we focus on businesses, number one. Number two, we like companies which have a long opportunity canvas. So it should be able to give me that runway for growth. It should not be a quarter or 2-quarter phenomenon. The growth runway can be a 3-4 year period where it doesn't matter whether I get in now or a year later. It will still have some leg to go. And we know markets tend to do excesses on both sides. And if you have a credible management, and last but not the least, you have to buy it at a reasonable price. So price of entry matters because that is your only margin of safety. So this is a very small, or rather should I say very simple way of how we run portfolios. As you rightly said, we have a lot of products which we manage. We have a grid, we have a large cap growth portfolio, we have a small and mid cap growth portfolio, we have balanced as in a large cap and or other flexi cap special opportunities fund, which is what I mentioned, that we are trying to get it on the AIF platform as well of late. And that's how we try and offer various products to investors depending upon where his belief and faith combine. So that is how we try and do this. And in terms of what else? Yeah, you mentioning that if I can share some existing schemes, right?
Yeah.
So in fact, let me pull out.
Maybe any one of them you don't want to share.
In fact, we have made very simple products. Our team keeps doing this, so be able to give investors a look into products which is good for them to be able to understand very easily. Yeah, I'll just put this.
Sure.
So if you see now, this is yeah. Now this is our large cap bias portfolio, which is large cap growth. So if you see here, large caps are roughly 70% in this portfolio, which we call the core equity. So here these portfolio holdings will be very distinctly large caps, and the theme is that it is a large cap bias portfolio, and that's why if you see, you will clearly see the weightages are more aligned to, like, let's say, the most large cap indices. The one on the right is the small and mid cap portfolio. Now here, this will be about 70% large cap core equity. Select sector will be 70% small and mid. And if you see the differentiation, the beta here is slightly, here we try and make this almost similar. Right now it is on a 3-year basis, but the difference is that the EPS growth, in fact, this we'll just correct this number. This is more closer to 25% based on the revised estimates. So this is roughly a less than one-time peg, because we believe that is what gives you some stability in a mid-cap scheme. So the targeted growth rate is more closer to 24-25%, and the multiple is about 22, and the beta is 0.93. Now, mind you, in a small and mid-cap scheme, I have bought ICICI Bank as my large cap number one weight, because if it is a small and mid-cap scheme, that doesn't mean I can't hold large caps, but I need to be able to give that stability. So therefore, you are likely to see that we've tried to impart that by making this kind of differentiation. Hence, the median market cap will be slightly high, but the weighted average market cap will be, the median market cap will be lower, but weighted average market cap will be higher. So those are kind of subtle nuances that we do while trying to manage the portfolio.
So Sabit, if you look at the large cap side, investors are moving even for passive funds these days, even on the mutual fund side. Do you think the PMS can create additional alpha over there?
Well, I think that is the basic aim, Vishak, because the reason why we take money is, and in fact, that is one, and I'll just address that through here, because if you see, this is our multi-cap scheme, which is what we are launching on the AIF platform as well. Now, this is a special opportunities fund. Now, special opportunities is not stressed situation. Special opportunities means that right now there is, because of an unknown event, a price dislocation, which is available in a great management company. So the basic hygiene factor between a special opportunity and a stress situation is management ability. And that is what we aim to do here. So this is now almost a 5-year track record, which is now on the PMS platform, which we are now launching on the AIF side. And if you see the scheme, currently as we speak, it has about 63% large cap and about 32% small and mid. And we've done reasonably well now on a 3-year return. If it's 29% versus a Nifty of 26, the alpha is there for you here, and you're not taking very high risk. It's a 21%, 21 time portfolio targeting about 18% earnings growth and 0.9 beta.
So is it more of a value approach? Can I say that?
Yes. So see, for us, we like to have that approach as an underlying across our theme, because if you see across all our major products, you will always see the PEG ratio is not very high for any of them. So they are not very high P to G and they are not very high beta, but at the same time, they have delivered results.
Yeah. The other question is, Samir, you've been running mutual fund as a house, mutual fund business for over 2.5 decades now. We see some of your schemes delivering similar numbers on the PMS side. In fact, some of them have. So what's your take on that? Number one, looking at the overall track record of the Aditya Birla alternate channel.
No, so you're asking
Any
about the
correction that you made after taking over?
You're asking about PMS or you're asking about?
So I'm saying that as a house, see, I'm the investor. I'm asking this question on behalf of my investors. That's the first question they have, that they already have, given, they already have exposure to mutual funds. Aditya Birla. Now, when I am positioning your PMSs, so first question which comes is that what is the difference between these two?
Well, the difference is very clearly that this is a far more focused, concentrated approach. It will tend to have its shades of underperformance, outperformance in the short term. But I think over a 3-5 year period, there is reasonable evidence to believe that track record of alpha has been generated. So, and the reason is perhaps because the way we approach things, the way we manage schemes, we try and keep overlap low. For example, you will find most, say, barring an ICICI Bank, most of our products will have very different schemes, different names in the top five. That is by design, because we don't like to have a very high degree of overlap. उसमें सब एक साथ ऊपर जाता है और सब एक साथ नीचे आता है. So, we don't want to, I mean, as a conscious strategy, we don't do that. And at the same time, because we believe there's merit in it, and we look at all the metrics which we put up there because we believe they are important, and they are important decision makers and creating differentiation as well. So, I mean, उससे ज़्यादा मैं क्या बता सकता हूँ यार?
नहीं ठीक है, मेरा कहने का मतलब है कि after you've taken over, what changes that you are undertaking which can give more confidence to us as an investor to take a bet on Aditya Birla PMS and AIF?
Because I think we can only communicate what we are doing, and we can tell you why we are doing that, which is what I've been trying to do this, till the time we began our interaction. And the reason why we do that is because we have confidence in the way we approach it, and why, and the merit of it, and hence we believe we will continue to do that. So our schemes are very sharply positioned. If a core equity will have 70-75% large cap, that is the way it will always be run. A select sector will always have 70% small and mid. That is the way it will be managed. And we have 4 quadrants here: small, large, small, and mid, growth and value. So that's where our products are positioned, and that's how we run them. So since you were asking value, well, I think a top 200 is, you will probably see that it will have, it is relatively more value. For example, it is better earnings growth at a lower multiple compared to the other schemes.
Sure. So your beta is remain at 0.85 to 9 to the schemes.
Yeah, I mean, so there are certain hygiene checks that we do. We don't like to run with very high beta portfolios. We don't like to buy very expensive multiples. I mean, in case, so therefore at the markets are at 18,800. So we like to look at P to G. So if it is a 22% earnings growth, I am willing to pay 22 times at a portfolio level. So it is individual stock. It doesn't matter. We need to look at aggregates. And that's where the whole thought process is. And I think that has worked for us in the past. So if you realize, since you asked me what has changed, I think this grid approach and the way we run portfolios in terms of low overlaps, and using the peg as a, not only as a outcome, even as a point of idea generation. So for example, if I have 3 names to choose from, I will try and see that versus one or the other. If I do, how will it change my weighted average market cap, median market cap, P to G, the beta? So all those are taken into account before you do portfolio construction.
All right. So my last question, and then we'll open the forum for Q&A quickly. So Samir, you spend almost 2.5 decades in the markets now. You work with veterans. They're there, like you work with Ramdev, you work with at Enam also, you work with promoters, and your own experience of last 25 years. People are saying that next 5-10 years are going to be different altogether. So what according to you, do you think, or do you agree, or are you in sync with this thought process that you have not seen these kind of days? What you have, because you've been there in the market for last 2.5 decades.
Well, because I think I mentioned that even in the last conclave when we met, I think in India, the big drivers are the digital public infrastructure. I wrote about it also. I think that is where we will unlock a lot of room for growth. So therefore, I don't think that the India story is something that will perhaps this time it's clearly different, because this time it is the first time you are being able to create that impact at a population scale, and that has implications. And it will be far more inclusive and hence sustainable. So we are on the right side of the equation as far as the demographics is concerned. We are on the right place as far as the contributory population is concerned, and you have a great productivity enhancing tool like the digital public infrastructure. So I think all this looks to be a good thing, and at the same time, the other factors like your capex revival, your the whole the services exports theme, the GCC spanning across all over India, and the services now becoming almost. I mean, today our exports are at $775 billion in. So I think our percentage contribution or our meaningfulness to trade or our relevance as a contributor to the global trade will go up manifolds from here. The PLI, I mean, there are so many things. So it's not just one thing. But at the same time, yes, markets have done well. Last 3 years we've done a 25% CAGR, which is not bad at all, even though you're coming out of a COVID base of say March 20. But at the same time, from here onwards, the next 3-5 years look to be good. Yes, obviously it will not be a straight line. You have state elections, you have general elections, and obviously there tends to be a lot of noise. But I think the Indian story is clearly having much stronger legs this time around.
All right. So with that, we'll conclude the session here and take some questions from our investors. So the first question which comes is, how do you compare PMS and AIF? Which one is better and why? I think we've already discussed a few minutes back and in detail. In fact, we talked about the merits of structures, AIF and PMS. So would you like to add anything? I think Samir, we've already discussed in detail. This is from Rahul.
Yeah, I think because this is, we, as you rightly said, we've discussed structures, we've discussed AIF gives you slightly longer runway in case of a closed-ended one. And otherwise, from a fund manager perspective, for me, both the products are absolutely the same. I look at individual stock, I look at its weightages. So as from a managing perspective, there is no difference. From an investor perspective, obviously, one is more, shall I say, open-ended, which is the PMS, whereas AIF can tend to be both having a higher entry in terms of commitment and maybe more closed-ended.
Right. So Rahulji, I think as mentioned by Samir, clearly the answer lies with you. Actually, you need to decide that what is your horizon. If you're looking at next 10 years, 15 years, then obviously, clearly you should be looking at PMS. But if you have horizon is 5-6 years time, and you're looking at playing out a particular theme, say for example, service theme that they wanted to play on. So you have time horizon of 5 to 6 years. Then clearly that is something you should be looking at. So instead of, if from a fund management point of view, Samir has clarified that I am going to look at the weightages based on my own conviction. It has nothing to do with structure. I'm not even going to look at the tax angle, because for me, when I'm running the portfolio, I would look at which one can deliver the highest return. Okay, but when you look at your own portfolio, you need to look at that. What is your time horizon? A, and second is, what is it that you are looking at? What kind of returns that you are expecting, and whether that is in line with what Samir talked about, which is the portfolio earnings and the pack. Because eventually you make as much money in the stock market as company makes. Maybe 2 or 3% additional alpha you can add. Second question, Rahul, again from you only before I go to Ramachandraji. And Ramachandraji, you can ask questions. You can unmute yourself and talk to Samirji directly.
Yeah. Am I audible?
Yes, sir.
Yeah. See, the question is the next year the general elections are there. So what is the Indian growth story now? We all say next year, following years are going to be very good for India. But if there is a change of government at the center, will it affect the Indian market? This is my question.
Well, Mr. Ramchandran, I think we've seen in the past what happens is that elections, they tend to be, in the short term, slight contributors to, sentiment or noise changes. But I think over the long term, development and growth as an agenda is now, uniform across most parties. So I don't see any regressive steps being taken on the policy front. Yes, maybe the speed could vary, but yes, there are tend to be sentimental reactions or overreactions, but they don't last for too long. So these are non-events when you look at it over a 5-10 year investing period. But yes, in the short term, it could create some dissonance. So that's fine. So markets understand that, and we've dealt with it in the past, and we'll deal with it in future as well. But I don't think that it has the potential to disrupt the India growth story.
Okay,
Yeah,
thank you.
I agree with Samir here that even the public has become very demanding now. They look at which government is delivering what. So obviously, we as an economy have become more mature, and I think long way to go. But anything can happen, Ramachandran ji.
Okay, thank you.
We'll take next question from Sharad ji. So Sharad Gupta ji, आप unmute कर लें अपने आप को, and then you can ask question. Can you hear me, Sharad ji? Okay, while Sharad is resuming, we'll have few more questions. So next question is again from Rahul. Can you explain the different categories of AIF? So I'll take the question first, and then I would request Samir to add. So there are 3 different categories broadly. So Cat 1 is more about, essentially investing in startups. The Cat 2 is more about investing in private credits or infrastructure underlying. And Cat 3 is more of pure listed equities, maybe some amount of unlisted. Samir, do you have Cat 1 and Cat 2 ideas also running?
Well, at least right now, we don't have, we have a Cat 2 planned, but at the moment, no.
Okay. So you have had some funds in the past where you run, you have real estate team, separate team. Is that correct? On the
Yes,
side?
correct.
But as of now, you're raising funds only on Cat 3 side, right?
Yes. We have only 2 products on the Cat 3. One is an open-ended, and the other one, the services one, which we just closed last week, that was a closed-ended. But both are.
When you say open-ended, can you explain this for the benefit of our investor? What do you mean by open-ended?
Well, open-ended Cat 3 means that there is no final close date, which means it is like a PMS. You can come in or go out at any point in time. But in a closed-ended one, like the services fund, now the fund is closed, it cannot take further subscriptions. So that's the basic difference.
Right. So maybe last 1 or 2 question, and we'll conclude here. Sharad, are you able to hear us, and would you like to ask a question? Because I can see that you have raised your hands. I think there is some connective. Yeah, he is again. So you have to unmute, Sharad ji. आपको unmute करना पड़ेगा वहां से. I'm getting your chat, but आपको yes.
Can you hear me?
Yes.
Okay. Samir ji, you mentioned that PMS is good for long-term, no, it is good for long-term investors. But now the PMS sellers have been telling us that it is the best thing for people who don't want to do day-to-day supervision of their investment, and therefore they should go in for PMS. And even if, say, for example, my age is 70 plus, and they have highly recommended that I should, because I don't want to spend much time on the computer or on the market or day to day or hour to hour. So they have highly recommended PMS. And you had told me just the opposite thing. So I'm confused. What do you say?
No, I think firstly, I must say, Chachu Ram, for the benefit of everybody, gentleman happens to be my.
I didn't want to say that. Anyway, Ram, carry on.
So I think, Chachu, I think here I would say that the basic difference is PMS gives you the ability to give your money to a hands of a manager after understanding the mandate. So you first understand the mandate, get your buy-in, and then you give it to him to work on the money. You don't need to do it yourself. The option is everybody is a fund manager. If it is your money, you can manage it yourself. So you can clearly do that. But the PMS manager, after he tells you what he intends doing with it, what is his scheme mandate, how he wants to run it, thereafter, then you allocate to him and then you let him perform for 3 to 5 years. That is what we are trying to say.
Okay, but we have done the opposite. We never got into the details of his plans. We just gave it. We'll be cautious in future. Thank you, Samir.
Thank you. Thank you.
Carry on, Vikas ji.
Vikas, we can't hear you. No, you're on mute.
Yeah, Sharad ji, can you hear me now?
Yeah, I can hear you.
Yeah, so मैं ये बोल रहा था कि आपने सही बोला कि आपकी एज पे डे टू डे आपके लिए ट्रैक करना बहुत ही असंभव वाली बात है। इसमें होता है सिर्फ हम लोग क्या ट्रैक करते हैं, कई बार भाव ट्रैक करते हैं। भाव ट्रैक करने के अलावा भी बहुत सारी जो चीजें होती है कि कंपनी से बात करना, उसकी बैलेंस शीट को इवैल्यूएट करना, तो एक्चुअली ये बहुत पूरा फुल टाइम जॉब है। तो इट इज बेटर कि आप एक पोर्टफोलियो मैनेजर अपॉइंट करें और उनको आप ट्रस्ट करके और ये मैंडेट दें, तो ये ज्यादा बेनिफिशियल रहेगा सर, मुझे ऐसा लगता है।
Yeah, thank you. That's what we did. But as Samir ji says, that for long-term investors at this age, PMS may not be the best thing.
नहीं देखिए, इसमें मैं थोड़ा सा एज अ वेल्थ मैनेजर आई वांट टू ऐड फ्यू थिंग्स हियर। देखिए इसमें क्या होता है कि सबसे पहले तो 60 के बाद में इक्विटी में इन्वेस्टमेंट तो ऐसे भी एडवाइजेबल नहीं है, इफ यू आस्क मी, क्योंकि आपकी रिटायरमेंट लाइफ होती है। अगर लेकिन आपकी सारी लाइबिलिटीज पूरी हो गई है एंड यू वांट टू गिव दिस मनी टू योर नेक्स्ट जनरेशन एंड ऑल योर लाइबिलिटीज आर ओवर, सब कुछ हो चुका है, घर बन गया है, गाड़ी हो गई, सब कुछ हो गया है, इमरजेंसी फंड है, तो आपको एडवाइजेबल है कि आप इक्विटी में डालें। सबसे पहली बात तो ये एस्टेब्लिश हो। दूसरी चीज, हमें अच्छी लगे नहीं लगे, 2-3 साल में पैसा बनता नहीं है, तो अगर वो होराइजन नहीं है तो फिर डाल के परेशान होना 70 की उम्र में ये भी ठीक नहीं है सर। क्या होगा फिर, आपका बीपी बढ़ जाएगा और वो रिटर्न नहीं बन पाएगा। तो ये तो बनी बात है कि डालना है तो 5-10 साल के लिए है। अब क्वेश्चन ये आता है कि भाई 70 के एज में विकास आप मेरे को क्या एडवाइस करते, मैं रखूं कि नहीं रखूं? सर अगर आपने डिसाइड किया इक्विटी में रखना है तो अगर आप 70 से 80 तक के पारी खेलते हैं तो 10 साल में बहुत बड़ा पैसा बना देगा इक्विटी। तो हमें ये चिंता होती है कि 70 के बाद में मैं क्या 75 भी कर पाऊंगा कि नहीं, पर अगर रह गए तो उसका क्या? आप दूसरा पहलू देखिए, पॉजिटिव नेगेटिव दोनों देखिए। बट अगर 80 तक आपने पारी खेली तो अगले 10 साल में आपका पैसा यहाँ से 5-6 टाइम्स वेल्थ क्रिएट हो सकता है, जो मेरा अनुभव बोलता है।
I agree. It all depends on your risk profile. How much risk you can take. Whether you are 70 or you are 50 or 40. And once as you said, all your commitments are over and you are soundly placed in your kitchen expenses and day-to-day and your normal discretionary expenses, then putting in equity, I think, is the best. Because earlier, people avoided equity because the liquidity was poor.
Correct.
But now I find equity is as liquid as a fixed deposit.
Right.
In fact, sometimes better than fixed deposit.
Absolutely.
So on that logic, I go for PMS or for equity investment, even at my age. Because as you said, my commitments are over. It is all whether I can liquefy my equity today or tomorrow, like I would like to do FD. So I prefer to go in for equity. At least there's some chance of building it up, right? FD puts a sort of ceiling on it. You can't get more than that. So that's my logic.
Absolutely, Sharad ji. In fact, abhi Samir ji ne
Samir only has taught me all this.
Okay, sure.
I am his chacha.
Great. So then I'm not needed.
Because in fact, look at it this way. The other argument is that now, as 40 is the new 30, 50 is the new 40, so life expectancy is also increasing. So which means there are more possibilities of people, even in the senior citizen group, they will also look at equity because health standards are good, medical availability is good. So people have a long runway. So why shouldn't they let their wealth compound?
Right. No, absolutely. It was pleasure talking to you, Sharadji and Ramachandranji. Thank you for your participation.
Thank you. Thank you. It was a pleasure to attend this session. Thank you.
Thank you. So thank you, Samirji, for all your time. We'll like to conclude the session here. Thank you for answering all the questions so patiently. And it was pleasure asking these questions on behalf of our investors so that they get the clarity as far as Aditya Birla alternate channel and PMS is concerned. So thank you.
Thank you, Vikas. A pleasure always.